Welcome back to the Deep Dive. We're here to give you the context and the strategic takeaways from the latest corporate updates. Today, we're diving into Ascent Industries, ticker ACNT, and their Q2 2025 results.
Exactly. And the big theme here really is this massive pivot ACNT's been executing. They're shifting from, well, a pretty complex, diversified industrial setup to becoming a pure-play specialty chemical company.
Right. So our mission today is to figure out if that transformation is actually showing up in the numbers yet, or, is the market still focused on the leftover costs from the transition?
Well, judging by the stock's initial reaction, it seems like caution is still the word, maybe cautiously constructive.
Yeah. Let's hit the headlines first. Top and bottom line were, well, a little soft. Net sales came in at $18.7 million. That's down 13% from last year.
Although they did get a bit of a sequential lift, up 5% from Q1.
True, but the GAAP diluted EPS, that was a loss of 25 cents per share, which is actually worse than the 14-cent loss they posted the year before.
Okay, so those headlines definitely paint a picture of a company still, cleaning things up and doing it against a pretty tough industrial demand backdrop.
But if you peel back that layer, the constructive part of the story, it really comes down to the margins, doesn't it?
Absolutely. Gross profit was up huge, 73% year over year, hitting $4.9 million. And that pushed the gross margin up significantly to 26.1%.
And that expansion is really what grabs your attention. We're talking, what, almost 1,300 basis points year over year?
Well, 1,298 basis points year over year. And yeah, 888 sequentially. It's a massive jump.
So that margin quality, that's kind of the proof point, right?
Strategically, it's almost the only thing that matters right now. It's the financial proof that the core chemical business they're building can deliver strong economics. Even while the overall revenue number looks weak, it really helps de-risk the long-term story.
Okay, but despite that strong margin performance, the reported adjusted EBITDA was still negative, a loss of $0.3 million. How do those two things square up?
Right. That brings us to the adjustment management was keen to point out. They argue, look, if you pull out the costs still hanging around from the legacy sites.
The stuff they're getting rid of.
Exactly. Then the core chemical business actually generated a positive adjusted EBITDA, about $181,000 they calculated. So the margin expansion is real, but that drag from the old business is still weighing down the reported earnings numbers quite a bit.
Okay, but they do have the financial resources to handle that drag, right?
Definitely. They ended the quarter with $60.5 million in cash sitting on the balance sheet. And importantly, zero debt drawn on their revolving credit lines. That dry powder is, well, it's critical for what comes next.
Let's unpack the pivot itself then. Q2 was a big milestone, you said.
A huge milestone. They fully exited the tubular segment. The company confirmed the final sales closed.
That's right. BRISMET went in April for $45 million.
Yep. And then ACNT closed right on June 30th for another $16 million. So that officially wraps up the sale of all the operating assets from that old segment. Functionally, ACNT is a pure-play chemical company now.
Functionally. But there's still one piece left over.
Yes, one last bit of the past. And it's really the main thing holding back the earnings improvement right now. It's that idle tubular facility they still own in Munhall, Pennsylvania. Management was pretty direct about it. It's the only remaining drag.
And it's not a small drag either. What was the number? $2.1 million annualized headwind to adjusted EBITDA.
That's the figure. It cost them $475,000 in Q2 alone, just sitting there. They said they're actively looking at different ways to deal with it, sell it, lease it, maybe remediate it. They need to resolve that stranded cost.
So that Munhall facility is like the last ghost of the old diversified ACNT.
It really is. It's a good reminder that turning these industrial companies around isn't just about spreadsheets. You physically have to dismantle the old stuff and get those costs off the books to see the potential of the core business underneath.
Okay, back to those impressive margins. What drove that improvement? Management flagged a few things.
Yeah, three main drivers. Strategic sourcing, basically getting better prices on raw materials, optimizing their product mix, focusing on the higher margin stuff they make.
Yeah.
It just plain pricing discipline.
And the operations team pulled their weight, too.
Seems like it. They mentioned over $1.2 million in year-over-year savings from improvements in labor, overhead, and production variances. Real operational gains.
Now, for the listeners who track the accounting details closely, there was a reclassification this quarter.
Yes. Important context. They moved about $1.2 million of support costs related to that Munhall facility, moved them out of cost of goods sold, COGS, and put them into SG&A, selling, general, and administrative expenses.
Why do that now? What's the thinking there?
It's really about clarity. COGS is usually where you judge the efficiency of your operating plans. By shifting the costs of an idle, non-core asset out of COGS, they're trying to give a cleaner look at the true operating gross margin of the chemical business.
Makes sense. Did they say what the margin looked like if you adjust for that?
Yeah, they indicated that even if you normalize for that shift, the gross margins still showed strong expansion, settling around 22.4% for Q2 on that normalized basis. So it backs up the idea that the lift is structural, driven by better chemical operations, not just an accounting change.
Okay, portfolio cleaned up, margins improving structurally. The focus now has to be on growth, right? Commercial execution. Management's pushing this idea they call chemicals as a service. What does that actually mean?
Yeah, chemicals as a service, or CAMS, it's their description of a hybrid model. They're not just slinging barrels of chemicals, they're doing custom manufacturing, formulation work, blending, handling complex logistics, even compliance support.
So solving problems the big guys won't touch or the smaller distributors can't handle.
Exactly. They're aiming for those complex niches where they can add value and presumably get better pricing. That's the value proposition they're building on.
And is it working? Are they winning business with this model?
The Q2 numbers suggest yes. They secured $3.1 million in annualized new revenue during the quarter. And importantly, they booked that business at an attractive 29% gross margin, which is well above their historical average.
That's a good sign. Where did that new business come from? New customers?
Interestingly, no. A full 88% of those wins came from expanding business with existing customers. That points towards, good customer loyalty and that the KS model is helping them cross-sell effectively.
And the pipeline looks good too.
Apparently. They mentioned the selling project pipeline grew by $25 million just in the last quarter. Management seems confident that will translate into more significant revenue growth heading into 2026.
Which fits with their longer-term goals. What are they aiming for?
They believe the current assets, the plants they have now, can support somewhere between $120 million and $130 million in annual revenue. And they're targeting those classic specialty chemical economics, gross margins in the 30% to 35% range, and adjusted EBITDA margins around 15%.
Okay, need to add a dose of reality here, though.
Yeah.
The broader economy isn't exactly booming for chemicals.
That's a crucial point. ACNT managed sequential growth, but the overall specialty chemical sector is struggling. The U.S. manufacturing PMI reading was below 50 contraction territory at 48 in July 2025. So the fact ACNT grew sequentially in that environment does suggest their specific product mix and strategy are working, at least somewhat independently of the macro tide.
Let's talk capital allocation. They have that $60.5 million cash pile. What are they doing with it?
Well, they've been active buying back their own stock. Repurchased about 644,000 shares in the quarter. That's around 6% of the outstanding shares at an average price of $12.15.
And they made a point about why they were buying back shares, didn't they?
They did. Management was very clear. The buybacks were purely because they see the stock as undervalued. They explicitly stated it was not about supporting executive equity plans or anything like that. It's meant as a signal of conviction in the intrinsic value.
Okay, what about M&A? Using that cash for growth?
They talked a lot about discipline here. They definitely want to do deals, but they're emphasizing a rigorous approach. They prefer starting with smaller, bolt-on acquisitions to make sure integration goes smoothly and limit the risk.
They even gave specific financial targets for deals, which you don't always hear.
Right. They're aiming for assets trading at around 6x to 8x post-synergy EBITDA. That's after they factor in the cost savings or revenue gains they expect. But, this raises a question. They have $60 million, the pivot's done, the balance sheet's clean. Is focusing only on small deals maybe too timid?
Yeah, especially in a fragmented sector like specialty chemicals. Are they risking sitting on that cash and depressed earnings for too long while they wait for the perfect small deal?
That's the debate investors are likely having. Management's counterargument is their discipline. They said they've already walked away from several potential deals because the price wasn't right, specifically mentioning they won't pay more than 8x or 9x pre-synergy. Their view seems to be that patience and finding the right deal, even if smaller, creates more value than rushing into something bigger and riskier just to deploy cash quickly. Quality over speed.
Okay, so that discipline actually makes it easier to track the potential catalysts. What should investors be watching for?
Three main things, I'd say. First, obviously, how and when they deploy that $60.5 million cash M&A announcements or maybe news on capacity additions. Second, any signs of demand recovery in their key markets, which would boost that top line. And third, continued evidence of that margin traction holding up, proving the Q2 performance wasn't a fluke.
And maybe some technical factors too.
Yeah, potentially some index-related trading flows. The company was added to the Russell 2000 index at the end of June, so that could influence things.
Got it. Any updates on governance? That sometimes comes up during transformations.
Just a quick note. They acknowledge that with the shift to pure-play chemicals, the board needs more specific industry expertise. They stated they recognize this and are actively working on adding that kind of representation to the board.
Okay, we've covered the results, the strategy, the capital plans. Let's shift gears a bit. Time for our not financial advice segment, where we explore a plausible, if maybe aggressive, trade idea for a professional audience.
All right, given everything we've discussed, what's the thesis for an aggressive re-rate trade on ACNT?
The core idea is long ACNT, probably using call options to get leverage, and it's a bet specifically on accelerated capital deployment over, say, the next 12 months. The setup is the pivot's done, the balance sheet is strong, but reported earnings are still weighed down by that Munhall facility drag.
So the drag creates a temporary discount, and you're betting that gets resolved and the cash gets put to work faster than the market expects.
Exactly. That Munhall drag creates this sort of multiplier effect. When it's gone, and if cash gets deployed accretively, the earnings jump could be quite sharp.
So your betting management hits both levers, M&A, and buybacks almost simultaneously.
Precisely. The trigger event, or maybe pair of events, you'd be looking for within 12 months would be, one, they announce a nice, clean, accretive M&A deal, something smallish, hitting that 6x post-synergy target they talked about. And two, they significantly step up the pace of the share buyback program, maybe even using up the current authorization quickly.
Okay, I see. That dual deployment buying growth via M&A and buying back their own cheap stock would definitely put pressure on the market to reevaluate. It could force that re-rating towards specialty chemical peer multiples much faster and accelerate their path towards that $120 million plus revenue capacity target.
It's fundamentally a bet on strategic urgency winning out over that very cautious discipline they highlighted.
Right. The underlying business improvements are there. The structural changes are done. This trade leverages the timing and pace of capital deployment to capture the re-rate. The options provide the leverage for a potentially high return if that specific sequence of events plays out.
Okay, so let's wrap this up. What's the core takeaway from ACNT's Q2?
I think the takeaway is that ACNT has successfully done the hard structural work. The pivot is complete in terms of the operating portfolio, and the underlying margins of the chemical business look genuinely strong. But the market is still, understandably, in a show-me phase. They need to see sustained top-line growth, and critically, they need that Munhall issue resolved before fully pricing this as a clean specialty chemical story.
Which leads us to our final provocative thought for you, the listener. ACNT has $60.5 million in cash, and management is emphasizing M&A discipline. The core question now is, can they actually translate that balance sheet strength into profitable growth soon? Or does that very discipline risk becoming too conservative? Could they end up holding too much cash while demand stays soft, delaying the re-rating they want, and maybe letting competitors make moves?
It's definitely the key tension to watch as ACNT moves into this next phase. A fascinating setup. Thanks for tuning into this deep dive.
We'll catch you on the next call.